Hi, I'm Arjun Parthsarathy, INR Bonds, and welcome to Search for Yields, the weekly newsletter from INR Bonds. And in this week's topic, we cover the crisis that could be caused by government bonds, not corporate bonds. So, as you all know, in 2008, 2007, 8, when the Lehman crisis happened, it was largely caused by corporate bonds, and there was a huge upheaval in the credit markets globally. And this caused a huge collapse in financial markets. Equities fell, the economy showed negative growth. Central banks had to step in and do a lot of accommodation to get the markets on an even keel and get the economies back on track. But this was caused by a bubble burst in the corporate bonds. But this time around, as we go about almost 13 years later, or 12 years if we take COVID in 2020, then when the COVID crisis happened, then the central banks did the same what they did in 2008 crisis, or they started to throw money in the system. They increased the purchase of government bonds. They brought down interest rates to record lows. In the US, it went to 0%. In the Eurozone, it went to deeply negative. And they bought tons and tons of government bonds. And this also took down government bond yields to record lows. And in the Eurozone, for example, most of the government bonds are trading in a negative rates. But at that point of time, the focus was on saving the economies from COVID lockdowns and very deep recession, which the central banks did not want to last, make it last, and did not want economies to go into long-term recession. But given that they had already done a very strong kind of stimulus in 2008 and they couldn't roll it back fully, and this 2020 crisis, they again had to do the same thing. And so effectively what they did was they added so much of money in the economies and in the global markets in terms of money printing that inflation started to rise. And yesterday we got the figures from the US that US inflation is at 40-year highs of 7%. They've never seen 7% for a long period of time. And just to think of it, that anybody who's under 40, anybody who's say under 40 in the US has never experienced such high inflation. Now, so this is a very, very worrying factor. And in the Eurozone too, inflation is at record high levels, closer to 5%. And in Eurozone, with so much of pensioners and retired population, with an aging population, then such high inflation, it's very difficult for them to even sustain their lifestyle. And with all this, with government bond yields at record lows, 0% and negative, the data in August shows that there's well over USD 16 trillion of government bonds that are below 0% yield in yields, and inflation at 5%. Now, the biggest buyers of government bonds, apart from central banks, are pension funds and insurance companies who largely cater to long-term retirement savings. Now, when these pension funds buy bonds at negative yields, then they are actually earning zero or nothing less than 0%, while inflation is at 5%. So they are not able to give any kind of returns to investors. And investors who are invested in fixed income directly to avoid volatility in other classes like equities, then they're also seeing that their capital is every day falling just by investing in risk-free government bonds. So clearly, I think clearly there is a huge problem with inflation, and with central banks now starting to really worry, panic on inflation. Now, with 7% inflation in the US, 40-year highs, and 5% in the Eurozone, the Fed and the Fed is in the risk of keeping on saying that they expect inflation to come down, but inflation may not come down at all and start to rise more and more. And if that happens, then the Feds will then clearly I think the Fed will cannot really hide behind the fact that they will have to take a more patient look for 2 to 3 years, because if it doesn't happen, then they are in the territory where they even the federal central banks have never been before. So if you central banks have always thought that they were had inflation under control and they could target inflation, but when it rises so high and suddenly they find that they don't have that under control, and then they are forced to raise interest rates, then what happens to all the investments made in government bonds by investors apart from central bank, especially the big pension funds and insurance companies and sovereign wealth funds, etc. And so this, and even investors' investment in municipal bonds and other government bonds, and all this can actually have a very strong repercussion. So this could even cause a kind of financial crisis in the global economy, where the crisis is actually led by government bonds, not corporate bonds. And so this is the biggest risk that faces investors across all asset classes, including equities, including cryptos, and including any other asset classes that they are investing in. And hence, central banks have to be very vigilant. Fed and have already started to take steps, but they might have to take it very, very fast and very, very strong rather than take it very easy if they have to make sure that they are able to convince markets that they are in control of where the inflation is heading and the long-term savings of people, especially indirectly through pension, through the retirement savings. So this is one of the biggest risks that search for yields sees in the global market. But at the same time, now search for yields is happening with inflation at high levels and government bond yields at so low levels where it's causing panic with at the investor level. Then there is a lot of money that is moving towards well managed issuers in the corporate debt market across the globe. And also Indian issuers are also benefiting from that kind of movement of money. And if you're able to service this kind of debt through prudent policies, then India will continue to see some very good money flowing into its debt markets. Thank you very much for listening in to Search for Yields, and do not forget to log into our QuickInvest platform given in the link is given in the description below. This will give you the best bonds to invest in to take care of all kinds of your requirements for savings, and gives you the most information, transparency, and the easiest of investment processes. And if you're not signed on to our YouTube channel, please do so.